Good day, ladies and gentlemen, and welcome to our class on MACD. Now, one of the interesting things that no matter where I go, no matter what I do, whether I'm going to a seminar, whether I'm meeting new traders, whether I'm conducting a meeting, or sometimes just in the street, or as always my friends, they always ask one question: what should I buy today? What will the prices be tomorrow? What will they be next week? Do you think the S&P is going to keep going up? Should I buy S&P? Should I sell the S&P? What do you think is going to happen with Apple? What do you think is going to happen with Facebook? Is Microsoft going to fall now that the Gateses are getting divorced? I got news for you. I don't have a crystal ball. I don't have a Ouija board, and neither does anybody else. So if anybody's trying to tell you they know what prices are going to be later today or tomorrow, they're full of it. There is no magic in the markets. There's no super secret sauce. So if you're attending today's class in the hopes that using MACD and technical analysis has all the answers to these questions, I'm afraid I have to disappoint you early. It doesn't. However, if you're attending this webinar with the hopes that using MACD will improve your investing and trading, that I have good news for you. That it surely will. So let's start talking about one of my favorite indicators, the moving average convergence and divergence. Sometimes I call it my secret weapon. Remember, I just told you nobody has any secret weapons. Well, when you can't tell what price action is trying to tell you, we always sometimes need a little bit of help. I don't use many indicators and oscillators. I'm a straight price action trader. I like support and resistance. I like some candlesticks, not candlestick patterns, and chart patterns I love. But I very rarely use an indicator. But sometimes it's kind of confusing what the market's trying to tell you, and an indicator can help you do that. Now, MACD was developed in the 1970s by Gerald Appel. Now, when we think back about the 1970s, what do we know? There was no internet that I know of. There was no PCs. There was no Windows. There was no forex trading. There was no CFD trading. And the markets moved a lot slower. And you would have to call your broker and tell them to buy or sell something for you. And it would eventually get done on the floor. And what was the most popular item traded in those days? Stock market, stocks. They followed not far behind by some commodities, but commodities had some speculators, but very, very few, because you couldn't get the data. You couldn't get economic reports. You couldn't get weather reports. We didn't have 24-hour TV. We didn't have financial news network. And like I said, we didn't have the internet. So it was very difficult. And I was trading on the commodities exchanges back then. And it was a very nice, slow way to trade. But if we stop to think that MACD was developed for a slower moving stock market, and it worked and became one of the most reliable indicators in the market. It helped us spot strength, direction, momentum, and the duration of a trend in a stock's price. Well, as forex began to grow, and as online trading forex began to grow, MACD started to become one of the most reliable and popular indicators in the forex market, because MACD works extremely well in fast-paced markets, in short time periods, and it has become one of the most accepted, reliable indicators that we have. And MACD tells us a lot of stories, tells us a lot of information about the markets. So the MACD indicator is typically placed at the bottom of your trading screen in a separate window beneath the price action. The moving average convergence and divergence is, and I like saying that, the moving average convergence and divergence is a relatively easy tool to use. It's not very complicated. Now, the basic concept behind MACD is fairly straightforward. Essentially, it calculates the difference between a 12 and a 26-day exponential moving average. Just the difference. So let's go over and try to do this ourselves and see how it works. Let me pop up a live chart here for you. And actually, let's do this correctly because MACD uses exponential moving averages, or EMAs. So let's go down. Let's add in these EMAs instead of using MAs. Exponential moving average, come on. Moving average, exponential, and do it again. And we're going to get rid of just the MA. And where did these go on my charts? Let's try this again. Moving average exponential. A moving average exponential. Okay, so MACD starts out with a 12-period EMA based on the close of the time frame, and we're going to make that bright gold. And let's thicken it up so we can see it. And that is the gold line that I just placed on our chart. So that is this big, thick green gold line going across the chart. That is a 12-period EMA, a moving average of the euro-US dollar. Okay. We all use moving averages for lots of things, but they don't really tell us much about the markets. Why is it a 12-period? I can't really answer that for you. I don't know all the studying that went behind Gerald Appel's research, but he came up with the combination of a 12 and a 26-period exponential moving average to start out his MACD. So we combine that with a 26-period EMA using the close, and we're going to make that, let's make that a dark purple. Thicken it up. And so now we have these two EMAs on our charts. We have the 12-period, and we have the 26-period. Now, there's lots of gurus out there that tell you to use a 10 and a 22 or a 14. These are all their individual own systems. But the fact is, Gerald Appel developed with a 12 and a 26. It's been tested and used, and almost every bit of literature you read is based on a 12 and 26. You can always customize or modify an indicator, but once it does, you have to do all the back testing so that you know that it works well based on how it's supposed to work. Now, if we were to use these two lines on our chart, and we were to say, look at the crossovers, that would be simply trading a moving average crossover strategy. That's another different strategy, and a simplistic one at that, but a very popular one. But this is only the beginnings for Gerald Appel and his MACD. Because MACD is an indicator of an indicator of an indicator of an indicator. So what we do with MACD is we take this number here and subtract this value here, and we plot it below the chart. So we take the value of the 12-period EMA, known as the faster EMA, and we subtract from it the shorter period, the longer period EMA, or the 26-period EMA. So what we're doing is we're taking this number, subtracting that number, and plotting it down here. So this line that I dropped down below is called the MACD line. It is simply the value of the difference between those two numbers above. There's no other part to it. There's no other thing involved in it. It is the difference. No matter what the math is, it is just the difference, and you plot it below. The fact is, when the 12-period EMA is above the 26-period EMA, and subtract one from the other, you're always going to get a positive number. When the markets change and the 12-period EMA is smaller than the 26-period EMA, you're always going to get a negative value. So therefore, down below, we plot everything based on this zero line. So above that zero line, we know it's a positive value. That positive value tells us the shorter term EMA is larger than the longer term EMA, as you see up here. When we see it go into negative numbers, we know the reverse is taking place. But again, that just doesn't help us much. That's simply a moving average strategy. Now, Gerald Appel took his indicator one step farther and added on what we call the signal line. The signal line is a 9-period moving average of the value of the blue line. So in other words, we take whatever the blue line is, the difference between the two above, and take the last 9 periods, add it together, and divide it by 9. And we plot that on the MACD chart below, and that gives us the red line. So this value plus this value, plus this value, plus this value, plus this, back 9 periods are added together, divided by 9, and then plotted on the chart, and it gives us that line, the red line. This red line, in this case we're calling it the red line, actual name is called a signal or a trigger line. The rule of thumb is when the trigger line or the signal line crosses above or below the MACD line, it's giving us buy and sell signals. Now, you notice here, we had the red line cross the blue line, or the signal line cross the MACD line, and it gave us a buy signal. The market's moved up slightly. Here across below gave us a sell signal. Here across above gave us a buy signal. Here across below gave us a sell signal. Okay, you say, all right, that's a little bit hard to see. How do I see it a little bit better? Well, MACD takes us one step farther than this, and it gives us what we call a histogram. A histogram is a visual representation of all those values. So we can see in this histogram, actually, let me turn off the signal line and only for a minute, I'm going to turn off the signal line here. So what we have are the value of the MACD line less, we have the value of the two moving averages, and when those are plotted down below, they are actually the bar charts down below, so we can see how big that difference is on the histogram. We also have our zero line. Well, guess what? Whenever the MACD line and the MACD signal line cross, what is the value? When two numbers are crossing each other, they're the exact same value, subtracting one from the other gives you what? 0. So we know every time that the histogram goes above or below the zero line, or it turns from red to green, it's crossed each other over. When it's crossed over and down, we're getting a sell signal. Or we see in red, when we get crossed over and up, we're getting a buy signal. Now, we're also getting the momentum and the strength of the move, as well as overbought and oversold indicators. When these peaks and valleys get very high or very low, we're getting overbought and oversold. So we can see the whole story of not price action, but how the markets are moving. So we can see our buy signal to buy here, crossover again, sell signal to sell here, buy signal here, sell signal here. Now, there is one big fallacy or one big problem with MACD. The signals are very dependable and very reliable, except MACD does not take into any consideration how far that move will be. In other words, it can issue a buy signal that only moves up 4 pips and then goes back into a sell signal and goes down 22 pips. Where if you would have bought that, it would have been right. It moved up. But it would have not been a successful transaction for you covering the spread. And by the time you got in the market, by the time you got out of the market, you would have lost your shirt. So you have to keep in mind that MACD doesn't tell you how far or how strong that move will be when it issues the signal. So the signal themselves are very, very, very reliable. It's only interpreting that signal, and you can't do that on your own, on its own, without doing some other study. So in this case, here we got a buy signal. It would have been a nice buy. The euro US dollar from 120, 187, and you might have ridden it all the way up here to 127.32. You got a sell signal. Just about there. So you would have gotten out of the market, say, somewhere around here. You would have entered the market somewhere around here. You would have picked up a nice performance. You would have picked up a nice set of pips. Okay. But there are other times where you don't. So you have to keep in mind at all times, you have to use other tools, and especially extremely good risk management skills, to make sure that the signal you're getting or the alert you're getting, and let's think of it more of alert, can be profitable for you to trade. So let's go back to my PowerPoint. So remember, the MACD histogram is an elegant visual representation of the difference between the MACD and the 9-day EMA. The histogram is positive when the MACD is above its 9-day EMA and negative when the MACD is below its 9-day EMA. If prices are rising, the histogram grows larger as the speed of the price momentum accelerates and contracts as the price movement decelerates. The same principle works in reverse as prices are falling. So the moving average convergence and divergence, MACD, is both a momentum oscillator and a price-based oscillator, and it's one of the more reliable studies that we have. If you combine it with like stochastics and CCI, or good price action interpretation, especially if you're using chart patterns, they work extremely well. So MACD is perhaps the best all-around study available. Indeed, this author, myself, considers the MACD to be the best single oscillator available and is valuable to learn its nuances in and out. Other than the price trend itself, MACD is one of the most accurate probability signals. The new trader would be wise to concentrate on really learning the MACD and its histogram before moving on. Because MACD gives you a clear look at what the market is doing. In downtrending markets, the fast-moving average will move down faster than the slow-moving average. As the fast-moving market diverges from the slow-moving average, MACD will illustrate that relationship. And in uptrending markets, the 12-period EMA should move faster than the 26-period EMA. And for those of you that don't understand what I'm trying to say, it's probably because you don't understand moving averages. So let's take the word EMA or E, exponential. It's S for simple, weighted for W. Let's throw them out the window. When we have moving averages, we're using a period of time. You can be using a 10-period moving average, a 20-period, a 50-period, sometimes a 100-period moving average. When you're using two moving averages or more, the moving average with the shorter period of time is considered the faster moving average because it adjusts faster to price fluctuations. Because if you're going back, say, 10 periods and you're using this period plus 9 periods back, and the price just fluctuated a lot in the last 3 periods, that 10-period moving average will adjust faster than if you were using, say, a 50-period. Because say price had been flat for 47 periods, and this started to rise in the last 3 periods. When you take all that together and divide it by 50, it's not going to show you much of a reaction. It's going to react slower. That's not necessarily a bad thing. One reacts quickly, more quickly or faster to the most current data, where the other reacts slower and takes in a longer period of data. So one is called, always the one with the shorter amount of time is called the faster. And when you're using a second moving average and it's using a longer time field, it's considered the slower moving average. Sometimes we're using 3, 4 or more, but you have to understand the differences in the words. So let's keep in mind that MACD helps traders notice a trend change from a very early stage, as the blue boxes over here on the right show that when a new trend is starting before the old trend has actually ended. As a key part of this indicator, and sometimes something we will delve into in following or more advanced strategies, is using the MACD trigger into trades. But before we go into that, you probably noticed that the zero line is very, very important, because at the zero line, that's when we know the moving averages are across. MACD will cross the zero line as the faster moving average intersects the slower moving average. MACD can be helpful for noticing potential trend changes at the very early stages of a currency pair's move. However, if we wait for the zero line crossover, we are essentially trading a moving average crossover strategy, which is inherently lagging the market and may not be the optimal entry point. This is where the signal line comes into play. And the signal line with the MACD line give us a more responsive piece of information. And that's why the histogram and the zero on the histogram are so important. Because the signal line is simply a moving average built on the value of the MACD line. By default, this is common set at 9 periods. So when the MACD line crosses above and over the signal line, it's looked at as a buy signal. When the MACD crosses below the signal line, is often looked at as a sell signal. And what it does, it makes us faster and more aware than using a simple moving average crossover strategy on the chart. In an effort to more closely follow the relationship between the MACD and the signal line, traders can follow the histogram, which is simply a bar chart plotted around the zero line to indicate the relationship between the MACD and the signal line. So MACD tells us 3 stories. And there are popular ways to use the moving average convergence: crossovers, overbought and oversold conditions, and those are the depth I use those only by you looking the depth of the peaks and the valleys in the histogram. And then there's divergence. I don't trade divergence. I don't even notice divergence in most cases. But divergence occurs when the indicator or that peak or the valley is moving in the opposite direction of price. So in other words, the peak of the valley is getting larger while price is starting to move the other way. So the basic MACD trading rule is to sell when the MACD falls below a signal line. Similarly, a buy signal occurs when the MACD line rises above. It's also popular to buy and sell when the MACD goes above and below the zero line. But again, a lot of people trade divergence. Like I said, I don't notice the divergence, but when your MACD line is moving in one direction while your price line is moving in the opposite, that means the indicator is diverging from the actual price. And it tells you there's something out of whack in the markets. And we have bearish and bullish divergence. But ultimately, remember that the MACD histogram is an indicator of an indicator. It's four-step removed from price. It starts out with the first derivative, which is the 12-day EMA and the 26. Remember the two lines we dropped on the chart. Then we go to the second derivative, which is that MACD line that we put on blue on the below, which is simply the 12-day or the 12-period EMA minus the 26 period. Remember, we talked about it always being above or below the zero line, and when you subtract one number from the other. Then the third is the MACD signal line, which is just a 9-period moving average of that blue MACD line that we looked at on the charts. And the fourth derivative becomes the MACD histogram. And that MACD histogram has crunched a lot of information, a lot of numbers, and everything into that visual representation of price. So as with MACD, the MACD histogram is also designed to identify convergence, divergence, and crossovers. So we get transaction signals, which is another way of calling buy and sell signals. But I like to say that they're alerts, they're not signals. They're knocks on the back of your head saying, hey, trader, take a look, here's a potential opportunity. The center line is always critical as price or as the, not price, as the MACD line and the signal line start moving towards that zero line. Now, the MACD line is one of the most popular tools in technical analysis because it tells us the momentum of the markets and the direction in which a market is moving. So remember, momentum in charting is like momentum in physics. If you throw a ball in the air, it will ascend at a slower and slower pace. After monitoring the changing momentum, a person can determine when the ball will stop climbing and change direction and descend. So just like in physics, momentum changes occur before the price of an asset actually changes. So keep that in mind. And the only way you're going to be an expert using MACD, and it's not very complicated, is not listen to gurus, not reading volumes about stuff, not reading and memorizing strategies. Put it on the bottom of your chart. Watch what it does. Watch what it says in reaction to the price on your charts, and slowly develop your own interpretation that fits into your personal ability to spot potential moves in a chart. So thank you very much, and we'll talk to you again once you've mastered trading with MACD. Bye now.